Okay, this is my second video in the series of discussing the capital asset pricing model, and in this particular case we're looking at the formula that underlines the capital asset pricing model, which is the risk-free rate plus the beta. And what is beta? Beta would be the relationship between an individual stock and the overall market. So how do we calculate beta? And we'll talk more about this in the series of videos. Is that we do a simple regression like you learned in high school algebra, where we look at the returns on a particular stock versus the returns on the overall market. And then we multiply that by the risk of the market, which is the overall return we would get by investing in the general market minus the risk-free rate. So it's simple, but it makes a lot of sense. And where a CAPM is the capital asset pricing model, a price for a particular stock, RF is the risk-free rate, B is the beta, and RM is the market risk. And the capital asset pricing model was developed in the early 1960s by William Sharpe, who was famed for the Sharpe ratio. We'll talk about that in future videos. Jack Trainer, John Lintner, and Jan Mosen. And it's based on the idea that not all risks should affect asset prices. And underneath you see a citing if you want to go and look at their original paper, which is interesting. If you're an academic, I would certainly pay attention to it. So that's the formula. I'm sorry for moving this around for the CAPM. What is the risk-free rate? Well, first of all, you have to earn the risk-free rate before you decide to take risk. A rational investor, not all investors are rational, but a rational investor would obviously want to take a return that has no risk before they would introduce risk into their portfolio. So the markets generally assume that the 10-year U.S. Treasury bond is the risk-free rate, and that it's riskless. And why is that? Is that the U.S. government is assumed to be the safest investment on the globe in terms of risk, and they borrow at the most efficient rate, considering all things considered, which are inflation and length of time and all the things that go into bond risk. The U.S. government has the lowest rate, and that's a conversation for another day. But why is the U.S. government? Why is that? Well, first of all, we have constitutional protection. So when you enter an agreement with the government or with any bond or lend money to any lender, there's a document in terms of a bond called the indenture, and that's the contract that governs the loan. And if either party runs afoul, and most notably the lender runs afoul, then you can go to court, is the bottom line, and courts will recognize it and they will act on it. So you have constitutional protection, and which may not exist in other countries. We also have the Federal Reserve that guarantees us monetary stability, which is the dual mandate of the Fed to have steady and sustainable employment, as well as a stable currency, which means it's protected against inflation. So we have a Fed that is constantly on the lookout for inflationary signals, or even takes action in a recession for deflation. So the global actors or investors are aware of that, and they consider the U.S. government to be the risk-free rate. And lastly, we have a stable political situation. Again, you can notice in many countries, in particular today in places like Venezuela, the governments do not seem stable. Well, here we have a trilateral government. This isn't a civics lesson, but we have a president, we have an executive branch, a legislative branch, a judicial branch, and they are checks and balances, and that creates a stability. So all of these things go into the factors that kind of deem the U.S. Treasury as a safe investment. And where do we find that quote? I took a brief screenshot, and that's from the Wall Street Journal, and this was as of the end of July, but right now it's trading at around the same level. And if you go to this site and type that in, or I don't think you can click on it. I don't have it set up that way. But you should make yourself familiar with the Wall Street Journal. It just doesn't have. It's not only the quote for this, but you'll find quotes for a number of yields and corporate yields and international yields. So at this point in time, if we're going to calculate the risk-free rate, well then you could put your money in the 10-year Treasury, earn 2.96%, and go to sleep at night knowing that you're not taking any risk. So in order to buy an equity, any equity, you'd want to be compensated to a much greater degree, or to a better degree than 2.96, and that's a function of risk versus return. So that's that'll segue us into the next part of our series. At least now at this point you understand how the risk-free rate is calculated. Obviously, if you were looking at a German stock or a British stock, or a United Kingdom, a stock that's domiciled in the United Kingdom, you may want to use the German Bund, or you may want to use a sterling denominated asset in the UK. But here we would use the Treasury bond. And that's just something I'm throwing out there. Generally speaking, I would use the Treasury bond. But again, if you're comparing apples to apples and going to other countries, you may want to consider that. So that's part 2, and we will continue the series.